Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
That would make me Guy Allard.
Thank you for listening. Remember, we developed this show decades ago, and it's to answer your financial questions. If you have any financial questions or you'd like to take advantage of our no-cost, no-obligation retirement plan, financial analysis, Social Security Optimize, or you just like to have any financial questions, we both have over 30 years experience apiece, and I'm sure we can answer them. If we can't answer them, it's very rare, but if we can't, we will find the answer for you.
And we'll tell you, we're not quite sure, but we'll figure it out. We won't make something up, I promise.
Right. Our number's 972-715-2424. Again, 972-715-2424, or you can always go to ilovemyretirement.com.
I was driving to work earlier this week, Victor, and last couple of shows we've talked about a couple times an ad that you'd saw, because we try to help the consumers and be an advocate, right, and tell them what to watch for. And it made me laugh when you talked about it. It was the 20% units that were available.
Oh, yeah, I heard it.
And I heard it again, and I found something else that's fraudulent in there that gives people the warm and fuzzies and might want to make them call. But just because of the wording, they might think the investment was guaranteed. They say that your investment... your investment is secured.
Right.
Now, you're buying real estate, right? So,
it's secured by the real estate.
Secured by it doesn't mean the real estate's going to be worth more. It could be worth a lot less.
Right.
But they say it. Your investment is secured.
And it's a 20% unit. So you're saying you're going to make 20%.
So you got a 20% unit, and your investment is secured. Are you not thinking that your money's guaranteed? It's secure.
It's safe and going to make 20%, right?
Oh, I saw I got to tell Victor.
Oh, we heard another one going to lunch this last week.
Yeah.
What was that about? It was, learn the secrets of a millionaire or whatever.
The secrets outside of Wall Street, or the
secrets beyond Wall Street.
Beyond Wall Street, that's right.
It's a life insurance policy, folks. That's exactly what it is. And the one thing about them, the life insurance, the growth story, unlike an index universal life, is actually pretty strong. The part they never talk about is the fee part.
Yeah, cost of insurance.
The cost of insurance. I'll give you an example. Let's say you put $100,000 a year into a policy, right? And you bought into this is wealth beyond Wall Street. That's what it's called.
That's it.
You buy into that. Do you realize they make between $100,000 and $120,000? Woo! Oh, man. Forget the 1% a year, 2% a year. You put in $120,000 over 5 years. First year they make $120,000. Then they make like 5-6%.
You understand these policies have to make that back, right? The insurance companies aren't just giving the money out. Right. But like Victor said, they're very good if you're the right age, if you're healthy, if you've got time to let it defer. You can have a heck of a good tax, not deferred, but tax-free income, as long as it doesn't become a modified endowment contract and you've got some hurdles. But you've got to be young enough. You got to have the money to put in, which is usually substantial, so that you can get substantial money out later. And you got to be healthy. And for most all of us, that height weight thing is tough.
I know, I'm supposed to weigh like $140. Like, what?
It's hard to make that height weight thing.
So, yeah. I mean, you got to be really thin, like a long distance runner, I think. They said I'm obese. I'm like, what?
Who makes those charts up anyway? Some 20-year-old? I think some 18-year-old comes up with that height weight chart. Because that's when I matched the height weight chart. It was about 18.
See, it's not like an IUL, Index Universal Life, is an illegitimate product like a life settlement, some of those life settlements, or some private, REIT deal that who knows you're going to get your money back. They're legitimate. I don't have an issue with something legitimate. The way I have an issue is how it's promoted and how it's sold. Yep. And if something's promoted and sold, saying you're going to make 20%, it's secure, well, that means no risk, right? Or they're saying, oh my gosh, it'll beat the pants off your 401k and IRA. I'm like, that's a fraudulent way to sell it. You're telling people they shouldn't invest in their 401k and they invest in your private crap. That is the worst kind of advice you could ever have. First thing, one of the easy things you can spot a real advisor versus either one that's delusional, a crook, or they just don't know, is somebody tell you, no, don't invest in that 401k. What do they match you? 3%? Okay, put that in only.
Well, and I think
put the rest with me.
Their qualifications are, if you're breathing and you can make it to their office, that's probably the investment for you. The other thing, Victor nailed that one, but the other thing is, too, if they don't take the time to ask you those questions, the ones you don't want to answer, but to really find out about you, find out your goals, what you have, all the things that we hate sharing. But it's very important to lay out a plan so that you make sure that your buckets, the 3 buckets that we talk about, are appropriate for what you want to accomplish.
Oh, yeah. Just got to make sure that, if you ever want to, there's a quick test on anybody that's, you think they're just selling you something or really a financial advisor.
A BS test?
Yeah.
And
just tell them, I've saved up $2 million. I don't like banks. I don't like the stock market. I'm thinking about putting it all with you. What do you think? They're going to jump at, of course.
In that
they
one
may
investment?
say, well, in most cases we want to diversify, but in your case, that might be a good thing to do. Either way, they're going to try to say something. Now, the SEC is coming up with a rule now. It's not finalized yet, because everybody calls themselves a financial advisor. I don't care if they sell, car insurance. They're calling themselves a financial advisor. And there's a big, how do you know who's a financial advisor or not? Every broker calls themselves a financial advisor. They're not financial advisors.
They're restricting that now
They're
somewhat.
starting to restrict it. Like a registered investment advisor like we are.
Right.
That is an advisor.
A fiduciary.
Yeah, that's right.
That's right.
A CFP, another fiduciary.
That's right.
But brokers at your big brokerage firms that you've heard of since you were a kid, selling mutual funds to you or individual stock to individual bonds, are not. And so there's a difference there. Now, don't get me wrong. Is there a place for everyone? Sure. If I'm a guy, let's say I'm a wealthy guy, and I just know I need to buy, 10 million in bonds every couple of years, well, go to the bond broker. Just know he's not a financial advisor. They don't have to look after your interest. None of that stuff. He basically just say a bond. If you're okay with it, you get it. Doesn't have to be the lowest price bond.
And
doesn't have to be the highest yielding bond.
They're sophisticated enough to know what they want and yield a call and all that good stuff.
Now, some of these, there used to be I can't remember the name of their website. You could buy bonds individually on your own. The problem is, you read the details on it. You could pay up to 8% in commission on some of these bonds.
That's crazy.
But it says bonds. We don't charge. We just charge a $10 transaction fee. They're talking about they eat into the yield and charge more. So it's like, it's disclosed. You just never read it.
And sometimes it's their own inventory they're selling and that whole thing. So
doesn't matter what they bought it for, like half the price, anything. They can do whatever. So there's a difference between that stuff.
I saw a good interview earlier in the week with Alan Greenspan, and I was going to try to capsulize that for everyone. I thought there were some nuggets, as there always is. Alan, as good as he was, is just another opinion. You're going to find for every Alan Greenspan, you're going to find somebody on the opposite end, and they'll both have a good argument. So our job is to kind of provide you with the information. You assimilate it and do with it what you think how it fits you best for your portfolio. Now, my question to you first, Victor, before I start is, I'm going to be quoting Alan quite a bit here, or at least using his quotes. So, Alan's interview, quoting Alan a lot. Is it okay to tell my friends that I had Alan Greenspan on the show?
Oh, yeah.
Okay, well, it's the same thing, right? Yeah, We're saying the same thing?
Sounds right to me.
Let's go with that. All right, Alan was talking, and basically the premise was the economy is poised to slow down in the coming years. And here's a quote from Alan. We are moving towards stagflation, and in the process of moving in that direction, it feels good, but it's a false dawn. So what he's talking about in stagflation, the first half stagnated, and he's talking about productivity. Everyone uses different things, whether it's PE or the GDP growth, but he was using productivity. And he said that had kind of stagnated, and we have some inflation coming on. And I'll try to tie this all together later. Then he goes down and he says, while signs of a slowdown are already evident, long-term does not exhibit a particularly powerful growth rate, which is what we were talking about.
Didn't we just come up to this growth rate, though?
Yeah. And then first, remember they were talking
coming back.
And a week or two ago, they were saying the first quarter of this year was a high water mark. Right.
Then it's gone. The market's down for the year now.
So here we go. But it's pretty interesting. All right, talking about the huge omnibus spending bill, especially coming in now with higher interest rates as rates are going up, are slowing down. He said, despite it's reaping the benefits of President Donald Trump's tax cut plan, and regulatory rollbacks, he still thinks it's going to slow it down. Again, because of the huge spending bill, and now it's coming in at a higher interest rate. So here's kind of where it gets good. The fiscal system is out of whack. That's a quote. And here's another quote. And while I approve wholeheartedly of the corporate tax cut and deregulation, the corporate tax cut unquestionably causes the deficit to rise, and we are not funding it by other means, funding the tax cut and all of that. Now, here's a part I thought was pretty interesting. He was asked a pointed question by the MC there, and his answer to why he thought all of this was true is he said it's a demographic issue. And he was talking about entitlements. He said as long as entitlements, and this is what I thought was pretty nice wording, as long as entitlements crowd out domestic savings, we're going to have that problem. And entitlements have gotten so large, and you think about it. You've got to save to invest. You got to save to grow. One of the things Americans are really good at, spending. So it's crowding all these entitlements, all these costs, everything that we've got to pay for. And, hopefully we'll get some of that resolved in a little bit more level playing field worldwide. But it crowds out our ability to save, which prevents growth. Now, my hope would be, whether it was Donald Trump or whomever was in office, that this is the beginning part, right? We've handled some of the rules and the regulations and the red tapes and all of that stuff. We've gotten that taken care of. We've got the tax cut. So I'm hoping that we see another leg, which will be handling the entitlements, cutting back a lot of the waste. I think we probably have the right guy in the office to do that, but I don't think anyone will tackle that before the midterms, do you?
No.
Taking away the entitlements.
They tackle it at all.
But I thought that was pretty interesting.
Yeah. The one thing, the counter narrative to that would be, because he's saying these tax cuts, no question, will increase the deficit.
And the deregulation.
And the deregulation. But what the counter to that is, we're going to increase productivity so much that it'll offset any of the taxes.
That's what Mnuchin's going around saying,
that's right.
For sure.
But so you need to go back and forth.
But it's a hard lift, right? You got to get to 3%, because the difference between 2% and 3% is where the real meat, where the rubber hits the road, and that's what really affords everything, right?
Yeah, people don't realize when you're a developing country, you can have these huge increases. Once you become the giant or whatever, it slows down a lot.
It's like trying to change an average of 5% for 40 years with just a couple of years before you can't. You need some big numbers that you move the average.
It's like China is still at, 7% or so? They were at double digits forever.
Is it a real number, though?
But the problem is they've got something coming up, like their interior of the country is, starving to death.
Infrastructure.
There's a lot of stuff they have that's starving to death.
Is 7% a real number?
You got to trust what they put
they got
out.
Currency manipulation, and they control the media. Wish we could, just saying. But anyway,
no, that is interesting.
Good stuff.
The thing about economists and things like that, man, you get two sides of everything. It still amazes me, if you're on the left or the right politically, how you absorb information that confirms what you're thinking and how you disregard the other. It's human nature. People do it. That's what people do.
Perfect example of that, Victor, was when McConnell was over here talking to Congress, and I forget what the line was, but I got to see some of the highlights after work late in that evening. And he'd say a sentence, and both the left and the right would stand up and clap. Well, you knew they were taking it differently, right? They both were clapping because they thought they were talking to them, and they weren't. He was talking to the left and globalism and all of that. But it was said in a manner which both people could take it and make it their own.
Oh, yeah. This is like if you've ever been to counseling with your wife or whatever, and the counselor says something, and you're like, "That's you!" Every time.
That's right.
And they're thinking, "That's you." The other way. No, she said it about you.
I don't know. I've never been to counseling with my wife, Victor.
Oh, I've been a couple times. It's a joy, I can tell you that.
Well, good. You're working at it.
It's usually a fest on how bad I am for about an hour. I'm like, come on, man.
She's telling you work too hard. Yeah. Oh, yeah. Too many hours at the office.
Oh, yeah. Care about the work, don't care about it. Okay, all right, let's talk about trust. I had some of this situation come up this last week, and one of my longtime really good clients said they talked to a lawyer, and the lawyer said, you need a trust, and we're going to put all your stuff in the trust. Okay, and I said...
Which lawyers tend to do.
Yeah. And I go, what was the need for the trust? Because I'm just asking a question here. She goes, well, it's because I want to avoid probate. Yeah, I'd like the thing to pass through my daughter, son, whatever. I don't want to tell who it is. But I would like them passed to them without any problems, blah, blah.
Any creditor proof, anything?
Yes, he goes, also maybe help, with a, Medicaid spend down, something like that. And I was thinking to myself, I'm real leery because lawyers will charge $2 or $3 grand, $4 or $5 grand for these things.
And then you have maintenance on them once you have them.
To an average person that doesn't need it. She had a lot of annuities. Annuities are already tax deferred, judgment proof, and avoid probate. They all get to it faster than a trust, the funds. So it already does all those things. And then some of the other accounts are IRAs. IRAs already do all those things. So then she said, what about, Medicaid stuff? I go, the government gets your retirement account balances every single year. Every trustee of your IRA 401k has to report what it's worth on December 31st of each year. That is for the government to predict future tax payments.
Right.
They know it's got this much in IRA. When they turn 70 and a half or earlier, we're going to start receiving this much. So they're reporting it to the government. So how could they ignore that if you went to a nursing home and they're saying, oh, okay, you got to spend this money down first? They're going to know you got $1 million in IRAs or whatever.
There's a paper trail.
All right. So in this situation, if they had a lot of annuities and IRAs, there's no need for a trust. That's just $3-5 grand you just wasted. Now, your house, maybe. There's another thing. Trust income. If you got some income-producing investments put in the trust, the taxes are ridiculous. What is it? It used to be 39.6% tax. 37% tax bracket. If income goes in that trust, over $12,500 a year.
Boom, you're there. The whole number right away.
$12,500 is the number. Now, I'll give you you got to make $500 grand to get that kind of tax bracket normally or something. It's a really high number. Not in a trust. That's why people think, well, the trust is going to save. Trusts do not save estate taxes or any other taxes. The government is smarter than that. They don't say, if everybody puts their money in a trust, we never get paid. They closed loopholes like that a long time ago. But that's what people have the perception of. Hey, it's going to be out of the hands of the government, and I get to lower my taxes. You're not going to lower anything.
Yeah.
What they're doing is, to prevent people from trying to put all of the trust, they gave you the 37% tax bracket. You make $12 grand in there. So income-producing stuff like an annuity or like bonds, CDs, they're going to get you above that number pretty quick. Now, what's a good in a trust? Well, a house appreciates, right? There's no triggered tax thing. It's appreciating. There's no income coming from a house unless you're rental houses. That's different. They end up putting them in a trust. You're going to have that trust at a high tax bracket. So trusts are good. And let's say you got a handicapped child you want them taken care of or whatever, or a super pet or whatever. They're good for that stuff. But a lot of times you don't need it. A lot of accounts, even if they're not IRA accounts, you can make them payable on death pot accounts at the bank, so they always got a beneficiary. So it's always going to go no probate and to your heirs immediately. They used to not have that stuff. It used to be only IRAs, but now you can pretty much make any account a beneficiary designated account.
You know, a good way to look at it, and a lot of times when I'm looking at a purchase or making a decision, it's called the old Ben Franklin, right? You put your list of positives and the negatives on one side. If you've already got it covered, it's not a benefit. So anything over and above what you've already got, you'd put in the positive column. And then you got to take a look at the expense. Now, other than the $3,000 or $4,000 or $5,000 to do it, other than the maintenance cost, which you have to pay the attorneys because you got to keep it updated. You got to. It's not once it's written, it's done. There's constant maintenance to make sure that it's always accurate and current. Then, because you had to get a tax ID number, you can use your Social Security, but the trust you have to have a tax form. Now you've got more tax expenses for your accountant because it needs to file a tax form. So there's a lot involved. It's harder to get your money out.
And don't get us wrong. We're not saying don't do a trust.
Absolutely not.
We're just saying for the average person, a lot of times it's not only not unnecessary but expensive.
You know, if you're passing money along, if you've got heirs that you are not sure what they're going to do with the money, and you want to control exactly how they get it for the rest of their life.
You've got a large portportfolio.
Lots of good reasons for a trust.
And even
but not for everybody.
Right.
It's like life insurance. Not for everybody.
Put retirement account or annuities in it.
That's right.
At all. Appreciating assets are fine,
yep.
Not income-producing assets.
And it's redundant in some of the benefits.
Oh, yeah. Because, like I said, they're already judgment-proof and they're for free. They got their tax deductible or tax deferred for free. All of those things, you don't have to pay anything, and it's not a hassle to move it. Now, some people even have a beneficiary as a trust, But I'm telling you, the lawyers do that, but they know the law. We know finance, and it depends on what your objective is. Because if you just double taxed your heirs and you didn't mean to because of control issues, well, you can control stuff pretty good in an IRA account without anything at all, no cost.
And Victor and I both have taken year-long tax courses on trust for the CFP and all of that stuff. So, I mean, we've got the knowledge, but because we don't do it every day, I almost consider it surface knowledge. So we consult with some of the best when our clients have the questions, just to measure twice and cut once. And like Victor said, there's some very good uses for a trust. But again, it's one of those things, whether it's stocks, annuities, it's not something that everybody needs to do.
I mean, we know, we've been doing this 30 years apiece, so we know pretty much all the tax law when it comes to investments, but we don't know the loss carry forward rules. You got some depreciate. I'm not an accountant.
That's right.
But I can tell you pretty much how things are taxed investment-wise, portfolio-wise. And I don't want to put anything, if I've got $100,000 income coming into this thing, I'm not putting that in a trust, especially if it's already an IRA, which makes no sense to me.
Yeah.
I get the control issue and all that stuff, but you can do that. And if you have annuities, you can actually control, because one thing that people sometimes come up with is, I've got 3 kids. 2 are very, good and savvy. 1 not so responsible. So I want to give that one an income stream. You could do that in an annuity. All right, I got $300,000. I want 3 going to each kid, but I want the $100,000 from this particular child going for a 20-year payout. And you can do all that stuff with no money.
Don't confuse that with a stretch IRA, because that's their decision, not yours.
That's right. Stretch IRAs, anytime you die, they can change it to take all the money.
There's 3. Yeah.
If you designate a payment to them, they only have a payment.
That's right.
And you can do that, like I said, without cost, without expensive lawyers, anything else. I'm not bashing the legal profession.
No.
It's just they're kind of like those guys selling, not
all of them. Some of them are.
Right. No, the guys selling the stuff where they're, it's always better beat the pants off your 401k, IRA, stuff like that.
Yeah.
They're just not, this is the way it's sold. There's nothing wrong with the trust. It's just sometimes people don't need them.
And they've been put into mind vice, too, since, how many years of college and the JD degree and all of that. And, they believe that you need to have one all the time.
Yeah.
Maybe not so much.
Yeah. And there's nothing wrong with having the trust, by the way, because with this particular client, they wanted their dogs taken care of. I said, that's good for a trust. The house, I want to make sure, that's good for a trust.
But I'm
just
telling
not your income-producing assets.
If you really need one, they're great. If you don't really need one, they're expensive, and they're a lot of work to keep up.
It's a pain in the ass to get rid of them later.
You can file taxes and get your money out, and
But it's not, like I said, they're definitely a place. Just really think hard what assets you have before you consider putting them in a trust. Because they'll tell you put everyone in a trust, and they'll have reasons. But I'm telling you, it doesn't offset the negatives. Some stuff is great to have in a trust. Some bank accounts, let's say you have a bank account, you can do it 2 ways. You can do it another way, have a joint account, so something happens to you, they still have it. That's another way to do it. But sometimes legally trusts work, because somebody could sue you later saying, no, Uncle Vinny, I was supposed to get blah, blah, blah. You can sue for the validity of a will or a trust.
Well, and you can break all of that.
That's right. The one thing you can't sue for the validity of is a contract. And that's what an annuity is, and a IRA that has a specific beneficiary. That is a legal contract. Nobody can sue it later saying, no, I was supposed to get it. No, the beneficiary is this person right here, and that's who's going to get it. We don't care what a trust or a will says.
And you can always break those. There's a story, if you haven't seen the movie, it's the Barnes Art Collection, which is worth 40, 50, 60 billion dollars or more. The guy was way ahead of his time. And after he died, he didn't want it to. He had the building. He had a trust for it. He didn't want it to move at all, and everything was done with the best lawyers in the world. And the college got it if the other trustees died. Well, the college got it, and then the mayor of Philadelphia and the governor of the state started adding board members to the college. And when they had enough board members to outvote the current board members, they were able to completely change it and break the trust. So
they sell all the art and everything?
No, they moved it to their own building in Philadelphia, which he was adamant about not wanting. It's called The Art of the Steal or something. There's a movie out about it.
Sounds like politicians.
They just absolutely took it.
Another thing came up this week with some clients. Loaded funds versus unloaded funds or no-load funds.
Yeah, or ETFs even in there.
That's right. Yeah, they had a lot of loaded funds. These were American funds. American funds a good fund family, nothing wrong with them. Very good fund family. But when you have a certain amount of money, you shouldn't be in loaded funds anymore. They're usually for people starting out. Don't get me wrong. I have examined portfolios with over $1 million in loaded mutual funds.
Yeah.
And there's no reason for it. Now, well, let me take back. Sometimes they don't have a no-load component to the same kind of mutual fund, but if you buy them in the same class, you can get them for no fees, even a loaded fund. You're still going to pay the management fee. But if you have over $1 million going in a specific loaded mutual fund, there's no fee.
We have a client, not to sidetrack you, that we work with, but he inherited $4 or $5 million in variable annuities.
Oh, yeah.
All in variable annuities.
Think about the fee structure. If it's
my goodness.
2 to 5% a year in fees on that thing.
Oh, man.
So
you wouldn't need more than one client.
No. That's what I'm saying. I don't like variable annuities if fees are too high.
Yeah.
But maybe we should just open a few of those accounts. We'll be rich pretty quick, right?
I'm shaking my head. No.
That's some expensive stuff.
It is.
Your loaded mutual funds, a lot of them, it's not uniform anymore, but a lot of them will end like an X, and that's a loaded counterpart. You should be able to buy ETFs, buy no-load funds, or buy even the loaded funds without the load. Nobody in the right mind that has any money should pay 5% load on a mutual fund.
And you should be getting price breaks depending on the money you put in your deposits.
But I've seen it where they put in pits at a time, blah, blah.
They don't aggregate it?
Yeah. Sometimes they do, sometimes they don't. But even then, some of the retail mutual funds are so much more expensive than an index fund or whatever. And there's still about, in 401ks, there's still about 3-to-1 managed versus index. And it's not because people understand indexes more, but there's still more managed mutual funds in 401ks than there are indexes. That's starting to change, though.
Don't you think exchange-traded funds, also known as ETFs, are almost replacing those just because of the...
They are a lot of times, but...
They're more nimble and...
Yeah, well, they used to have where they're passive versus active, right?
Right.
In the last few years, passive has killed active, but a lot of years, active kills passive. What I mean by active and passive, they actually buy and sell the stocks within the thing. An index does not. It's just static. The S&P is static, S&P 500, unless McGraw-Hill, which owns the S&P, changes a stock. Like they might change a Montgomery Ward's out of there and put a Best Buy, because that one's no longer relevant. This one is. Another common mistake is people think the S&P 500 is the 500 largest U.S. companies. It is not.
Right.
It's 500 large companies. Don't get me wrong. There's not a small one in there.
I've heard that before.
There's 500 large companies that represent all the different asset classes. So the reason why it can't be the S&P 500, what if the first 100, 200 were one type of company, tech companies or whatever, right? It wouldn't be a representative of the U.S. market. It would be representative of the tech market. So that's why they don't take the largest. They take a representative sample of large U.S. companies.
Speaking of diversification, I was reading an article earlier this week that said to be truly diversified, you had to have a portfolio with stock in over 40 countries in it. And I'm thinking, holy crap.
Well, no, that's too much for me. I'm okay with just American stocks, maybe a couple German, Japanese, something like that. Also, somebody asked me this week, another thing that came up. They said, I can produce more income than an annuity in the stock market. I said, really?
Well, the stock market's averaging 10%, isn't it?
Remember, it's made 5% for the last 18 years.
Right.
And I said, okay. Well, let's say it makes 7% a year. You got $1 million, and in 10 years we're going to start income on this thing. So we're going to defer it for income. So in 10 years we're $2 million, right?
Yeah.
Rule of 72.
0.72.
Right,
7.2.
So it's $2 million. Well, the 4% rule, which has been around forever, you'd be taking out $80,000, right? But they changed that rule at the end of 2013 because interest rates at these levels won't produce that much. 2.8 is the most you could safely take out of your portfolio and not run out of money. It gives you a 90% chance.
56,000.
That's right. So 56,000. I said, well, the annuity starts at 100, like 130,000.
On the same money.
You can have 130,000 guaranteed or 100 increasing to 200 when the best you could have done is 80 something. Or it's 56, right?
Right.
Well, that's our show, folks. I want to thank everybody for listening. Don't hesitate to call us if you have any financial questions. You'd like us to look at your portfolio, give us the most unbiased opinion we can. 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.